So everybody, welcome to Financial Statement Ratios. This is part 7 or other considerations, and this is going to focus on goodwill. So my disclaimer and copyright notice, the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2022 by Bennett Tchaikovsky. Note that the author does not claim any copyright whatsoever in any companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. Okay, so goodwill. What is goodwill? When we purchase a company, the books of that company essentially go out the window. We bring in an appraiser, we go through and we basically determine the fair market value of the assets that are being acquired, less any sort of liabilities. The difference between the amount that's being paid for those assets and the fair market value of those assets is goodwill. You never recognize goodwill. We don't say our employees are amazing, therefore I'm going to write up my assets. You never recognize that until a company is sold. The other part of it is over here when you're looking at goodwill, and again, this is from Investopedia. I'm going to actually give Investopedia a proper shout out because they do such a great job in terms of explaining things. Again, this is the market to book ratio. And when you look at the market to book ratio for firms, Investopedia, you're essentially backing out let's pull this up here. Let's go over here and okay, so what we're gonna go through and do, book value is the assets minus the value of its liabilities. There's something in over here going through a little bit more in depth, which is also book value can be calculated by subtracting total liabilities, preferred shares, and intangible assets. So when you're looking at this, it's how much of it would it have left in assets if it went out of business today. So this is really what the importance is of looking at goodwill, because goodwill, when a company, it only comes out of a company when it's going through and acquiring a business, that's where it comes from, right? So when you see goodwill on the books of a company, you have to be really, really careful about it. The other part is that it is not amortized. You're evaluating goodwill for impairment. So when it comes to doing a financial statement analysis, this is why you have to be kind of careful. So Meta Platforms or Facebook, right? We want to encourage Meta World Peace to make a deal with Meta Platforms right over here. So Facebook, September 30th, 2015, September 30th, 2021. The assets of Facebook at this date in 2015 were 46 billion. What Facebook had done is Facebook has made a lot of extremely strategic acquisitions. Oculus Rift, I always refer to them as Optimus Prime, but then I'm reminded that it's not a transformer, Bennett. It's, that's something else. But over here, you've got goodwill of 18 billion. This is a result of acquiring, I believe it was WhatsApp, Instagram. Facebook has grown a lot through acquisition, but however, for the last 6 years, their goodwill's only grown by roughly about $1 billion. So they have made more acquisitions, but just not as much in that period of time. But what's really fascinating, though, is when you look at Facebook, they have leveraged their goodwill to such an extent that look at what their total assets are today. It's almost $169 billion. Their liabilities have obviously gone up, but not at the same rate that their total assets have gone up. So goodwill, when it's done, when you're making the right strategic acquisition, can be hugely valuable, right? And that's not to say, does Facebook, is there goodwill, does it have no value? In fact, I would say the opposite. It's probably undervalued because of what their platforms are. So that's right over here in terms of what we're looking at for Facebook. Now, where you get into goodwill being a bigger issue is with other types of businesses. Now, this is really not fair because I don't mean to be kicking Macys when it's down. But with Macys, Macys has just slowly been declining like so many other retailers that are just operating in the physical world. Their goodwill has been written off pretty significantly. Now, what's weird about Macys is the value of Macys was in their real estate. They own real estate, which you can find articles on it, where their real estate value is about 16 billion more than what it shows on the books, right? That's another thing to kind of consider when you're doing financial statement analysis. So, but again, with Goodwill, when you see Goodwill for a retailer, you probably want to disregard it unless it is something that really has value. That's really where, for certain enterprises, it's going to be on a case-by-case basis. But when you go back to Investopedia and then going through and kind of talking about why we're removing it, it actually makes a lot more sense. So again, when you have Goodwill, should you be disregarding this for financial statement analysis purposes? I would probably say yes in most cases. But again, you want to go through and really understand what their Goodwill looks like. And Macys, this, in my opinion, probably should have happened a lot sooner. Again, Goodwill is impaired. And so why did this drop? It's because they finally realized that it's impaired and they had to take a write down. So anyways, in any event, so just kind of like my final thoughts on Goodwill. So if you're going through and doing a financial statement analysis, I would really just, again, say, look at it on a case-by-case basis and possibly disregard it, just because when you look at Goodwill, because of its very nature, which is that it arises out of an acquisition, similar to an operating leased asset, it's kind of thin air. Goodwill is actually more thin air than an operating leased asset or, leasehold rights. Because again, you have to look at a company without the Goodwill being there, just because, again, from an accounting perspective, that's why it's recorded, because to show the difference between the fair market value and the purchase price. Okay. So I want to thank you for joining me here today. If you have any questions about this presentation or any of the thoughts that I brought up in it, I would more than welcome them. Please don't forget to like and subscribe. I'm nearing 1,000 subscribers. Once I hit that, I'm planning on trying to get the CPA review firms to help me do a giveaway. I promote them and I give away something. So I'll be like my first sponsored video. In any event, I look forward to seeing you on the next video. Have a great rest of your day.